Well, welcome to week 5. In week 5, we're going to get into some very challenging information. So what I'd like you to do is put your, I wanted to say thinking caps, but you probably don't want to hear thinking caps, but that's really what you need. At any rate, we're going to be looking at accounting and cash flow. And whether or not you elect to do this for your own firm or hire someone else, it's important that you at the very least have a basic understanding of what's happening, because you need to be able to review the financial statements and make necessary changes and adjustments. You also need to have a pretty good idea of whether they look right or not, because as horrifying a thought as it might be, our accountants can make errors as well. So with that being said, let's launch into this particular topic. What do we know? We know that accounting is the language of business. One should be able to take a look at the key elements of an accounting system and interpret how well their business is doing. So if nothing else, can you look at a statement and see what your gross revenues were for the month? And did those seem to be on track with your experiences in the shop or the store? And are you making the kind of money that you thought you would if you had that kind of revenue? If not, you need to be able to look through the detail and figure out why not. Where did that money go? Oftentimes, again, we want to be able to use an accountant to help us with this, just because it is a complex topic. If we're going to be choosing an accountant, we want to try to find somebody who's fairly familiar with our industry. If we are a builder, we probably want an accountant who at least understands building terminology. That way when the invoices and whatnot come through, they know what's happening. It helps them be in a better position to help us with our business. They also have an idea of what typical margins are and things of that nature. There are two different kinds of accounting. There's managerial accounting and financial accounting. I've been basically talking to you so far from the managerial accounting position, which is you're able to review the financials and understand how your company is operating or how well it's doing. Financial accounting really looks at being able to present or review the financials in order to find lending or better enhance the financial position. So maybe I need to find more money to finance some growth for my company, which is great news, but I need to make sure my accounting statements reflect the kind of information that a lender is going to want to see. There are also a couple different kinds of systems that we could use for accounting. In cash bases, it's basically cash bases or accrual bases. In a cash basis accounting, we're literally tracking when the cash comes in and goes out. So the transaction is recorded when the money is received or spent. So for example, if I choose to pay the property taxes for my site for the next 12 months, I'd show the entire expense going out in the month that I sent the check. Accrual basis accounting records them when the event occurs. So sticking with the property tax example, if I were to write the check for the whole 12 months, I would only show the expense equal to 1/12 of the property taxes for each of the next 12 months. As a general rule, accrual tax accounting or accrual basis accounting is more reflective of what's really happening in your business, because you're matching the expenses with the time frame they're intended to pay for. But cash accounting is a little bit easier, and cash accounting actually lets you know if there's money in the bank to pay your employees on Friday. So you need to really be able to understand and use both. Another important element in our financial and managerial accounting are balance sheets. Now the balance sheet, it's dominated by what is known as the accounting equation, and that separates what is owned and who owns it within the firm, or as reflected by the balance sheet. And the accounting equation is assets equal liabilities plus owner's equity. Now the owner's equity is what the owners actually own. The liabilities are what you still owe money on. Okay, so let's say I bought a car, and I'm to make deliveries for the firm, and I put $1,000 down, and I borrowed $9,000. Okay, I have a $10,000 car. The assets on my book would show the $10,000 vehicle. The owner's equity is the $1,000 I put down on the car, and the liabilities would be the $9,000 that I borrowed in order to purchase the car. Okay, and you can see who has what ownership interest. The lender actually has the ownership interest for the note for the $9,000, and if you don't pay, they could take the car from you. Current assets, which are part of the balance sheet, we see several different sections. The current assets section basically shows the total current assets is equal to the amount of cash you have on hand, any marketable securities, your accounts receivable, in other words, the money that people owe you, any prepaid expenses, those property taxes, if paid out into the future, are prepaid, and your inventory. And the sum total of those is your total current assets. Your long-term assets, which is a different division or a different subject line in your balance sheet, are those assets that are not going to be turned into cash within the next year. And they include things like investments, fixed assets, depreciation, and intangible assets. Now, I'm not going to get into each of these because they get a little complex, particularly when we start looking at things like depreciation. But you want to, and of course depreciation is where you get to subtract certain value off the books for property that's getting old. For example, as that vehicle, 5 years after you've owned that vehicle, it's no longer worth the $10,000 you gave for it. It might be worth the $5,000. Well, how did you account for the use of that asset? It basically comes in through depreciation. You want to understand that this is happening. You at least need an accountant to be taking care of it for you because it is an advantage for you when you look at paying your taxes. We're not going to get into any more detail about that just right now. Long-term assets, let's see. The equation for our long-term assets is investments plus fixed assets minus any accumulated depreciation plus your intangible assets. An intangible asset might be something like goodwill. Let's say you've been in the neighborhood for the last 10 or 20 or even 30 years or whatever time frame that is, and people like you. They come to you because you're the neighborhood shop. You can usually include that as an asset on your books, and that would go under the long-term asset category. For current liabilities, those are debts and obligations that are intended to be paid within the year. And they're things like notes payable, accounts payable, or other items like taxes, wages, and rents, dividends that you might have to pay, which is an ownership interest payment to somebody, and the current portion of any long-term debt. Current liabilities equation basically looks at notes payable plus accounts payable plus other items payable plus dividends payable plus current portion of long-term debt equals your total current liabilities. Long-term liabilities are debts payable over a period greater than 1 year. Just like we had current assets and long-term assets, we have current liabilities and long-term liabilities. They include things like your long-term debt, any pension fund liability, and long-term lease obligations. What we want to know is that, or generally we want to make sure that our current assets are in a position to be able to pay our current liabilities. In other words, do we have enough cash and current asset value to pay whatever our obligations are over the coming period? And that's very, very important in terms of managing our small business or franchise. Another element on the balance sheet is owner's equity, and it represents the value of the shareholder's ownership in the business. It is sometimes referred to as your net worth, and it's composed of items such as paid-in capital and retained earnings. Again, when we were looking at our example, like the vehicle, $9,000 was effectively owned by the bank still because you owed on the debt, but you'd put $1,000 down on the car, and that would have been your owner's equity. Now let's say you were buying an appreciating asset like a business or your franchise rather than a vehicle. Well, but we're going to use the same basic numbers just to keep this simple. Let's say I borrowed $1,000, or I had $1,000 to put down on a business, and I borrowed the other $9,000. After a year in business, maybe rather than the business being worth $10,000, it was worth $15,000. Well, the difference between the $10,000 and the $5,000, or the $10,000 and the $15,000, is my money because I built that business. So I still only owe the $9,000 to the bank, but my equity interest is up by an additional $5,000. So I have $5,000 plus the $1,000 I put in, giving me a $6,000 net worth or net equity in the business because I built the business. And that's the fun part. So tracking that owner's equity, hopefully it's a trajectory that's moving up and showing how much money you're making with your franchise. Okay, that's basically what we're going to talk about in regards to the balance statement. We also want to take a look at the income statement, and that's a very important tool for managing your business. The income statement provides an examination of the overall profitability of the firm over a particular length or period of time. We typically have an income statement on at least a monthly basis, and we typically will also have one that projects over the next 12 months, or you could actually look at what your experience has been over the past 12 months. The difference is historical, what you've actually accomplished, versus projections and where you're hoping to be going. The income statement is basically your operating profit, or your earnings before interest and taxes, which is equal to the gross profit minus any operating expenses. As you can see, there are two elements to that. The gross profit is what you're selling, the total revenues that you're bringing in. Well, that's the gross profit minus any costs equals the profit. Your gross revenues are the total. When you subtract off your costs or your operating expenses, you're going to end up with your operating profit. Okay? The income statement, it brings us, as we continue to look at our income statement, we're going to see what is net profit. The net profit is the earnings before taxes minus any income taxes we need to pay. So bottom line, what are we trying to do? We have gross revenues coming in. Out of that, we're paying for any product or supplies that were necessary in order to have a product to sell. We're paying our staff, we're paying the leases, we're paying the electric bill, and we're going to get to a net profit. Then we're going to take off any other expenses, and including any income taxes we need to pay, and what's left is the net profit that comes to us. Now that doesn't sound, that often is quite a bit lower than our gross, and how well we manage those expenses tends to indicate how much money we're going to make. If we're wasting money in buying supplies, let's say we're buying perishables that we need to throw away, or we're not managing our employees well, and so we're having to pay for twice as many employees as we really should be, that all comes out before we get paid, or our net profits. And so learning how to manage is very important for our personal success. Okay? So basically we're looking at, in regards to the income statement, we have the gross profits, our operating profits, and our net profits. And ideally we maximize each along the way through careful management of our firm. As I kind of touched on in regards to the cash flow statement, there are two types of cash flow statements that we can look at. The historic cash flow, which shows, it's similar to the income statement that looks at the cash inflows and the cash outflows for businesses during a specific period of time. They're what has actually occurred. So gross revenues minus our operating expenses. Cash flow projection statement, which attempts to identify cash flows into the firm and cash flows out of the firm for some future period. Oftentimes we find that our cash flow projections are based on our historical cash flow. So if I'm in the business for 10 years and I see certain trend lines for the first 9 years of my revenues, maybe they're moving up or maybe they're flat or moving down, sadly, that's unless we make changes like through advertising or our marketing mix, odds are the cash inflow is going to be comparable to the historical. And so when I'm looking at a budget, I'm going to budget approximately the same, adjusted by any changes I've made that would cause me to anticipate a change in my revenues. I'm then going to basically do the same thing for my expenses. And that's my projection. And then generally what we want to do for managing our firm well is we want to compare, as we move into the future, compare each of those monthly projections against what's actually happening and adjust based on our successes or failures. Okay, let's see. We're going to move on to financial ratios because I'm not sure you've got enough accounting just yet. You might think otherwise, but let's move on anyway. The financial ratios are ratios that we take to help us evaluate our firm relative to maybe how we have done in the past or how other firms in the industry are doing. And it just lets us know whether we're on track or not. The financial ratios can be grouped into 5 different categories: liquidity ratios, financial leverage ratios, asset management or efficiency ratios, profitability ratios, and market value ratios. And each of these helps us to understand where we're going. Just for an example, a liquidity ratio might show our current liabilities over our current assets. And that will show us whether or not we have, it'll give us a ratio that shows us whether or not we can cover our expenses this month. If our current liabilities are in excess of our current assets, that's basically telling us we can't pay our bills. So we need to do something, whether it's borrow money. So let's say we found out that we can't pay all of our bills for this period. So we might look at financial leverage ratios. And that will help us determine whether or not we're in a position to go to a lender and borrow some money. Okay, I'm not going to get into each of these right now just because, again, there's quite a bit of complexity here. I do encourage you to keep worksheets that show you the ratios and allow you to work through some. Keep them handy as you're running your business because they are something you're going to want to review every once in a while. So long story short, what does this all mean? Small businesses and franchisees have to be much more proactive in attempting to eliminate or reduce negative cash flows, often because there's just not a lot of opportunity to borrow if you get into a bad position. This can be done by restricting credit and credit terms. So for people who owe you money, be very careful who you lend money to or who you let buy on credit. Buying on credit, allowing your customers to buy on credit can be a really good thing if they pay you. But if they don't, it's going to leave you in a bad position unless you can pull that money out of your pocket and pay your bills. Things like conducting credit checks on people before you give them a line of credit. Make your credit terms explicit. In other words, all payments are due within 30 days. And if not paid, we're going to cut off your line of credit. And again, you need to make sure that you as a business can afford to carry them if they're not paying you. And it's a reality of our world that sometimes people don't pay, particularly in the terms that we have offered them. We also might want to consider providing incentives to expedite customer payment. That might be something like a 2% 10, net 30. What that says is I'll give you a 2% discount on your invoices if you pay me within 10 days. If you don't pay me within 10 days, you still need to pay me by 30. Well, let's think about that. If you're giving them a 2% discount, can you afford that 2% in your profits? Or are you so close that you can't even afford to offer that 2%? So again, don't offer incentives that you can't carry as a business. And you might do things like requesting partial payment in advance when somebody wants, some credit terms. So what does it all mean? We want to take advantage of the technologies that is out there. There are so many software programs that help us with our accounting and cash flow. Keep them current. Run your statements every month. Allow the software to give you some of these ratios and compare them as time goes on. Make sure that you aren't making any mistakes or allowing an oversight. One of the biggest things that can happen to us is to gradually move into an error situation and not have recognized it. With all the tools available to us, maybe with our accountant looking over our shoulder, we're in a position to do what needs to be done. So make sure you're doing it. Good luck with your cash flow and accounting, and we'll see you in the next segment.